Hi, I'm Lucas from Quant Monitor. In this chapter, I'll explain why beautiful backtests often fail in live trading, and why walk-forward analysis isn't a method to improve results, but a method to reduce self-deception and increase a system's chance to survive over time. Most strategies don't fail because their logic is bad. They fail because the evaluation process is structurally naive. A backtest looks convincing, equity rises, metrics look stable, optimization produces great parameters. Then you deploy it and the system starts falling apart, often fast and without warning. That's not bad luck, that's misplaced trust in the precision of the past. Markets are non-stationary, volatility, liquidity, correlation, and behavior change. And any methodology that assumes stability will eventually break. Walk-forward analysis is not a performance trick. It's a survivability filter. Here's the core reframe. Performance is not something a strategy has. Performance is something a strategy produces under specific conditions. It's better to understand a strategy as a mapping. Market structure, rules, capital exposure, observed outcome. When market structure changes, the same rules generate different results. That's not a flaw of the strategy. It's a feature of an adaptive environment. That's why absolute metrics like net profit, Sharpe, or win rate are just outputs. They do not prove structural validity. Instead, ask, how does the system behave when regimes change? Does it degrade gradually or collapse suddenly? Does risk expand under stress or remain bounded? A single backtest can never answer that. Optimization is the most common trap in systematic trading. Most people use it as a machine to find the best parameters. In reality, its most important role is to reveal fragility. An optimization surface is not a recommendation engine. It's a diagnostic map. A wide, flat plateau suggests tolerance and robustness. Narrow peaks suggest overfitting. Sharp cliffs suggest regime dependency. A robust strategy is not the one with the highest peak. It's the one that is good enough across a wide range of parameters. And a key rule, optimization should primarily eliminate ideas, not select them. In-sample, out-of-sample splitting is the foundation, but a single OS segment is still just one historical scenario. It's one realization of the past, one volatility regime, one liquidity environment. Passing OS once does not equal robustness. It only means it didn't fail in that one window. Walk forward replaces the binary pass-fail mindset with continuous validation through time. It doesn't ask, did it work? It asks, how consistently does it survive changing conditions? The walk-forward framework forces a repeating sequence. 1. Choose parameters on a historical window. 2. Apply them forward without changes. 3. Measure degradation. 4. Refit. 5. Repeat. This is a simulation of real system life. The world changes, parameters age, and edge decays. Two critical things WFA reveals. First, window design. Window length is not a technical detail, it's a philosophical assumption. Short windows react quickly but easily overfit noise. Long windows smooth noise but lag regime shifts. There's no correct window. There is only coherence between strategy logic, market structure, and refit frequency. Second, walk-forward efficiency, WFE. WFE measures how much of the optimized potential survives forward application. High WFE suggests structural relevance and stability. Low WFE often indicates curve fitting, fragile assumptions, and noise chasing. A crucial reframe, high backtest plus low WFE, reject. Moderate backtest plus high WFE are viable. Smooth equity plus unstable WFEs are dangerous. Walk forward on a single strategy isn't enough if you allocate capital across a portfolio, because in portfolios, you don't just manage individual performance, you manage collective failure. Portfolio-level WFA reveals correlated drawdowns, synchronized failures, clustering of losses in the same regimes. This often exposes an uncomfortable truth. Diversification may be visual, not structural. WFA also reveals regime drift. The market changes slowly until it changes fast. Rolling windows tell you whether degradation is gradual or whether a structural break occurs. And then there's parameter stability over time. Stable parameters often suggest low sensitivity and strong structural alignment. Unstable parameters often suggest noise fitting or regime anchoring. WFA shows whether parameters oscillate, drift, or explode, and each pattern implies a different problem. The most important decision isn't how to build a system. The most important decision is when to stop trading it. Walk forward provides far more objective kill signals than emotion. Collapse in WFE, parameter instability, clear regime incompatibility, and most importantly, correlated portfolio failure. Killing a strategy is not failure. Failure is holding a dead strategy because it used to work. Many traders believe an adaptive system will fix itself. In practice, the opposite can happen. Adaptive logic can accelerate failure because it chases noise, amplifies short-term anomalies, and reduces human oversight. WFA often reveals that adaptivity improves short-term fit while reducing long-term survivability. And one more critical perspective on drawdown. Drawdown is not just a percentage, it's time spent in uncertainty. A robust system doesn't just want a small drawdown, it wants short time in drawdown, reasonable recovery, and minimal capital stagnation. WFA shows whether drawdowns cluster, stretch, and compound, or whether they remain behaviorally manageable. Walk forward doesn't eliminate risk. It doesn't predict black swans. It doesn't guarantee profit. It doesn't remove uncertainty. What it does is more valuable. It reduces self-deception. Robustness is not maximizing returns. It is preserving capital, maintaining psychological sustainability, and practicing structural humility. So WFA is not an optimization trick. It is a risk management philosophy. And the conclusion, markets don't reward cleverness. They reward adaptability constrained by discipline. Walk forward won't make you profitable by itself. It will make you a more honest system developer. And honesty is the only edge that lasts.